HELOCs are a little different where they're not like a Fannie Mae loan. They're much more dynamic than a Fannie Mae fixed 30-year loan.
The reason HELOCs can be very hard to get is if you open a HELOC for a $300,000 limit, the bank has to have $300,000 to give you, but they're not earning a return on that money. So it's one of the reasons HELOCs are hard to get.
HELOCs don't draw right away.
Investment property HELOCs are back.
That's where HELOCs really thrive.
Christian Batchelder, welcome back to Mortgage Mondays at BiggerPockets. How are you today?
Pretty good. How you doing, David?
You are the Bach of lending, the best loan officer I know, which is why we're in business together. And we've got an update for all of you about what's going on in the mortgage world. So first off, have any banks collapsed since the last time that we spoke?
Not, at least maybe some small local ones. Nothing that has really shaken up anything. Obviously, this is recorded after SVB, after Signature, after Credit Suisse. That have been discussed in previous videos. If you want to hear that, go check those out. But in these last 2 weeks or so, no, nothing really being shaken up significantly.
Okay, good. That's nice to know that we haven't had any earthquakes in the banking industry since then. But we do have some earthquakey good news. So one of the most common things that people ask about are HELOCs, especially when they don't have a lot of cash or they want to get access to their equity. And in that realm, investment property HELOCs are even harder to get than primary residence HELOCs. Let's start off by just explain to me why it is harder to get a HELOC on an investment property than it is on a primary residence in most cases.
The reason why HELOCs are kind of shied away from, especially when the market starts shaking up a little bit, is mainly because imagine if you're a lender, HELOCs don't draw right away. And all I mean by that is that you don't necessarily have to take that money. You can leave a HELOC with a $0 balance, similar to a credit card. But the lender has to make sure they set aside that money for you to use instantly, because HELOCs are supposed to be able to fund in 24, 48 hours when you request the money. So imagine if you're a bank and you have to set aside hundreds of thousands of dollars that is not returning you a yield right away, right? You still have to reserve that, but you're not making a return on it. And if anybody knows anything about banks, they like returns, right? So that's one of the reasons. On top of that, typically a HELOC is in a second position, and that's just a fancy way of saying you have a first mortgage. That's typically the loan you use to buy the property. And in second position, you have a HELOC, and that just means if you were to default or foreclose on the property, that first position has like authority of your payoff, right? That would have to be cleared before that second position lender would be reimbursed for the funds that they lent you. So that on top of the nature of a HELOC, banks sometimes shy away, especially when capital becomes an issue, and that's the world we're in right now, where banks are putting more focus on their reserves than they ever have, right?
Which, for good reason, right? After what we've saw with bank runs that have shut down several banks already, there's undoubtedly other banking institutions that have very similar concerns where
100%.
All these deposits came in, we printed all this money, people go put it in the bank. They have to do something with it. They can't just hold your money and pay you interest and not go do anything with it. So oftentimes they go buy bonds, which really is like eating vegetables. It's not exciting, but it's supposed to be safe. And we've raised interest rates so fast that the bonds that they bought were bought at too low of an interest rate for what they're worth today. So if people ask to get their money out of the bank doesn't have the cash on hand to give it to them. They'd have to sell bonds that are worth less than what they paid for them. The house and cards topples. I love your observation that the reason HELOCs can be very hard to get is if you open a HELOC for a $300,000 limit, the bank has to have $300,000 to give you, but they're not earning a return on that money. This is one of the reasons HELOCs are hard to get. And I love diving into this because typically as an investor, we're just like, do you have it? Can you do it? Well, why not? Okay, I'll go find someone that can, without ever understanding the underlying fundamentals of what makes this possible. Now,
Absolutely.
We do have some good news for you. At the One Brokerage, we've got a new product available that's been difficult to get. Would you like to unveil the shiny object for me?
Yeah, we do. It's funny. Actually, in the last 12 months, this has probably been our most requested, maybe outside of our DSCR loan, our most requested loan product has been HELOCs on investment properties. Something that we have not had access to. It's been very difficult to establish a banking relationship with a lender that, wants to offer this product. But we do have them now with some restrictions. Total leverage on a property can be 70%. So in an example, if you have a house that's worth $1 million, your first mortgage is $500,000, we could potentially get you a $200,000 HELOC, getting up to 70% of the property value. So obviously you can't go get 80, 85, 90 that you could with a first mortgage on some programs. But it still does allow potentially to tap into that equity when you have a really good rate on that first mortgage. So keep in mind, what we want to make sure that we're analyzing and what we would do when you reach out to us is making sure that we're still treating a weighted average of your mortgages. And all that means is if you have a really low interest rate on your first, but let's say your HELOC may be high, we would still compare that to just getting you a larger first mortgage, potentially at a lower rate, right? So we still want to be careful that we're not leveraging you into a situation that is worse than maybe just increasing that rate a little bit on your primary mortgage. But other than that, it's a good product. It fits a lot of people, especially those who bought investment properties in 2019, 2020, experienced a lot of appreciation, and you want to deploy that capital without losing your rate. It's a good option.
Yeah, that's something I did. I took investment properties on the first 4 or 5 investment properties I ever bought. They appreciated a lot, but rents were going up too, so I didn't want to sell them because every year the cash flow was getting better than what it had been. But I had all this equity that I couldn't get into, so I just took out HELOCs on it, and I would use that to flip houses or fund BRRRRs a lot of the time, and then I would refinance out of the BRRRR at the end of it, pay off the HELOC, and then have that capital set aside that could fund future deals. We often say when you buy real estate right, especially if you wait over a little bit of time, your previous deals will fund your future deals.
Yeah.
And that's pretty awesome because these have been hard to find for a long time.
They have, especially, and we've always had them on primary and second homes. Second home is just a vacation home. But investment properties have been notoriously difficult to obtain, and we got them now. So exciting announcement. Also want to bring some attention to the point that obviously we want to make sure that we're analyzing your plan for the HELOC. This is another huge question we get for HELOCs. You just said it a little, David, on your BRRRR projects, on something where you're renovating. HELOCs are very strong in the space of short-term financing, right? So it's just like a credit card, right? Typically, they're higher interest rate than a first mortgage. Typically, they're variable, which means they have an adjustable rate attached to them. And if you're using it to fund a project, maybe a down payment that you have a BRRRR coming up where you're refunding yourself that money and you can pay off that HELOC, that's where HELOCs really thrive because of the accessibility and the liquidity that they provide. I would not recommend taking out HELOCs and treating them like 30-year mortgages, right? They're going to be adjustable. They're going to be variable. They could get called due, right? So HELOCs don't have the same protections in lending as first, position fixed loans. But short term, just like David just shared, your BRRRR financing, your renovation financing, if you want to build an ADU in your backyard, stuff like that is where HELOCs really will thrive.
That is a great point. Oftentimes people will take out HELOCs as the down payment of their next property. And first off, let me just say, in today's market, I'm not saying don't do it. I'm just saying it's very difficult to pull this off. Everybody's having a hard time finding cash flow. And if you do find cash flow, it's very skinny cash flow. It's not that big, fat, tasty, cool cash flow we were getting for a long time. It's still possible. However, when you throw in that the property has to cash flow enough to pay the debt on the HELOC that you took out, it becomes even harder. And then when you take into consideration the fact that rates can keep going up, and what the rate was that you got on the HELOC when you originally took it out is not fixed. It can change. And is it usually every year, Christian? Is that when it adjusts?
Typically, HELOCs will have a somewhat fixed period, maybe a couple years, 5 years, where you're having a draw portion where you're only paying that interest and then it'll adjust. But some will adjust every year. It depends on the product. That if you're reaching out to us, we'd match you with the lender that fits your investment strategy. But they do variable. HELOCs are a little different where they're not like a Fannie Mae loan. Right, so this is really up to the discretion of the lender who's giving it to you. They're much more dynamic, right, than a Fannie Mae fixed 30-year loan. So those fixed periods could definitely vary. So
you're saying you may get a year, 2, 3 years or something with a fixed rate, and then after that it becomes adjustable. Most HELOCs are interest only, so you're only paying the interest, which is great. But what I'm saying is it makes it harder if you're using it as a down payment for your next deal to get a deal that's going to work when it's already hard because you have the added burden of paying off that debt and the added risk of the payments going up. They are much better, in our opinion, for short-term projects like flipping a house, funding a BRRRR, maybe doing some construction to improve the value of your house in a lower amount, maybe starting a business, right? You want to get into a real estate related thing and you're going to need 20 grand to start. That's not a terrible idea to fund that with a HELOC and pay it back with the money that came from the pros. Just some ideas to be thinking about. Another issue that I've noticed that can come in with HELOCs is many of them are either balloon payments that are due after a certain period of time. Like you said, it's not a 30-year fixed loan. So if you have it for 15 years, either it will be due in full, or what I've also seen is banks will convert it into an amortized loan. So they may say, okay, you are making interest-only payments. The interest rate is now whatever. You are now going to make principal and interest amortized over a 20-year period to pay back what you owe us. And when they add principal to the interest you've been paying, your payment goes up. We're just saying this so you don't get caught off guard. Now, usually 15 years later, rents are going to be much higher than whatever you bought, or you've added some valuable, but it isn't a permanent thing. This is a great way to get access to equity without losing that 2.99 rate that you're in love with, that you don't want to do a cash out refinance. Now, what about people who may have an interest rate that they like? It's not amazing. Is there ever a time where a cash out refinance can make more sense than a HELOC on an investment property?
Absolutely. Also, one of the top 5 questions that we get in terms of frequency at the one brokerage. And that's what I was referencing a little bit earlier. We'd want to be careful. Like, imagine if you guys had a 2% on your first mortgage, and this isn't where HELOC rates are, but let's say you had a 10% on your HELOC. Your average interest rate is pretty high, right? That's an average between 2 and 10. Whereas if you could just go refinance on a long-term loan for a 5% rate, the long-term loan actually puts you in a better situation than the averaging of those 2 interest rates.
All right, so this is fantastic news that we're actually getting some liquidity. We're getting lenders that are making loans. People are being able to get HELOCs on investment properties, but I will end with this. Do not assume these will be around forever. I cannot tell you how many times people have heard about a bridge product that we had, a DSCR product we had, a product that would allow them to take out a DSCR loan if they were negative cash flow or based off of short-term rental rent instead of traditional rental. We always have these little cool things that pop up, but they don't last forever. And when people drag their feet too long, the program goes away. They can't get access to the money, Christian. So if people want to reach out to you, learn more about this, get connected with the loan officer, what's the best advice you have for them?
Yeah, I'd say obviously with us, theonebrokerage.com. That is our website. It has an intake form at the top right of the page. If you want to get in contact with me directly, Christian@theonebrokerage.com is my direct email. I also got a BiggerPockets account. If you just search up me, you feel free to DM me on there. I check it every day. I'm always responding. But I just want to also stress that communication with your loan officer. Let them know what your exit strategy is, because when we do these HELOCs, we don't pre-approve you for a HELOC. We pre-approve you for your exit strategy. And we make sure you can get out of the HELOC if you're thinking short-term financing. If you're not having that conversation with the loan officer, I don't even care if it's not us. This is advice to all buyers working with all lenders. Make sure your lender is understanding what you're trying to do 2-3 steps in the future, so you're not cutting off your foot to spite your face kind of deal, right? Make sure that path is known so that the loan officer can lay those bricks for you to walk down.
Great point. Thank you for that, Christian. And if you're watching this on YouTube and you are thinking, I can't believe it, this is too good to be true, let us know in the comments what you think about the fact that investment property HELOCs are back and we got them, as well as what other topics you'd like to hear about in future episodes, and we will do shows on those. Please make sure to like, share, and subscribe to all of the BiggerPockets YouTube content, and keep an eye out for more stuff with Christian and I on Mortgage Monday. All right, Christian, have a good one.
Appreciate you, David.